Rise of Coins and Banking. Section 5 Disclaimer. Listen up, Lodu and Legends. Before we jump into banks taking over your money and your life, here's your warning. I am watching you from the chaos, sipping on the digital blood of fools. And by the way, if you think banks are safe, you might as well hand your wallet to Kartikai Chutia and Sudhanshu Chutia for a field trip. Also, real talk, while Americans created tech and banking that actually moved the world, here in India we copy shit, stress about hookup culture, and pretend our modern culture is advanced when all we really do is find new ways to be broke and horny. And don't even start thinking the stock market will make you rich overnight. If you believe that, you're the kind of idiot my ex would dump for a server crash. So buckle up. This is not financial advice. This is chaos therapy with a PhD in roasting. Keep your wallets, egos, and dignity close. Lodu and Legends, buckle the fuck up. Here's topic 2. Section 5 Introduction in pure Valhalla chaos mode. Topic 2. Rise of Coins and Banking. Section 5 Introduction. So now we enter the glorious era of banks taking over your ass and your coins. Listen, coins were cute, receipts were fun, but humans are lazy as hell. Enter the banks, the professional babysitters of money who invented the art of stealing with a smile. Kartikai Chutia thinks his 500 FD is safe. Sudhanshu Chutia thinks banks are angels. Meanwhile, Goldiebai is somewhere reading balance sheets like a psychic. And me? I am the god of Valhalla, aka Godsea, watching your wallet sweat as your money dances to someone else's tune. Banks started as, hey, we'll hold your gold, then realized, why not lend it out and charge interest? Fractional reserve banking was born. Translation, we lend money we don't have, take your cash, and laugh in the shadows. Legends understood scale. Lodu traders borrowed to flex, defaulted, and cried. Welcome to the first system of structured chaos. And here's a punchline for India. While Americans created banks that fueled tech, wars, and empires, we perfected the art of queuing, paperwork, and uncle-approved signatures. By the end of this section, you'll either be laughing at how humans never learn or plotting to become God-sea-level chaotic yourself. Deep dive. Banks took over your money. Full Valhalla chaos, simple English, savage roasts, and practical survival moves. Read loud, laugh, learn. Don't be Section 5 deep dive. The first banks and the illusion of safe. One-liner. Banks started as safekeepers of coins and turned into credit machines that grew empires, and the slickest legal way to take your money if trust breaks. Char 1. Quick TLDR. So even a Lodu gets it. People gave gold to keepers, got receipts. Receipts became money. Keepers, banks lent those receipts out. One coin supported many loans. Boom. Credit-fueled growth plus hidden risk. If trust dies, the whole thing collapses fast. 2. How a bank actually works. Stupid simple. You deposit 100 coins. Bank keeps some, reserve, and lends rest. Borrower spends that loan. Money comes back to system as other deposits. That cycle multiplies how much money exists without more metal. Bank makes profit by charging borrowers more interest than they pay depositors. Simple margin equals bank profit. Number 3. Fractional reserve equals growth engine, but also dynamite. Example, deposit 100, reserve 10, 10%. Lend 90, that 90 gets redeposited, new lendable 81, money multiplies. Good, funds trade, factories, ships. Bad, if everyone asks for coins at once, bank hasn't the metal, bank run. Real roast, banks invented leverage centuries before crypto bras did. Same arrogance, fancier suits. Number 4. Where banks make cash and where retail loses. Net interest margin, NIM. Borrow cheap deposits, lend dear loans. That spread is profit. Fees. Every small chit, transfer fee, ATM fee, Forex fee, gets pocketed. Securitization. Bundle loans, sell to others, move risk. Works until it doesn't. Trading and proprietary bets. Big banks can gamble with your deposits indirectly. Retail loses because deposit rates are tiny, loan rates are high, and fees eat returns. Meanwhile, bankers get bonuses. Number 5, bank runs. How trust dies fast. Rumor, weak balance sheet, or a shock. Depositors panic, withdrawals spike, bank liquidity collapses, asset fire sales, insolvency. Modern twist. One viral message or app freeze and digital withdrawals happen in minutes. Faster than your ability to yell stop. Lesson. Liquidity, Godsea moves in seconds. If Godsea leaves, panic follows. Number 6, central banks and safety nets. Why governments bail sometimes. Lender of last resort, central bank pumps emergency cash to stop runs. Deposit insurance, government guarantees small deposits to calm people, limits vary by country. Regulation, capital buffers, stress tests, liquidity coverage ratios, rules to reduce crashes. But safety nets create moral hazard. Banks take bigger risks knowing they might get rescued. Classic. Nutter 7. Shadow banking. Same game, fewer rules. Non-bank lenders, money market funds, repo markets. They act like banks but with less supervision. They provide credit fast and fail fast. When shadow funding dries, the real banks feel the pain. Roast. Those cool fintech yields are often shadow banking dressed up in a hoodie. Nice hoodie. Still a scam if the runway ends. 8. Digital banks and fintech. Prettier UI, similar traps. Pros: convenience, low-cost transfers, microloans. Cons: custody risk, who actually holds the asset, concentration, everyone on same platform, operational outages, and promotional rates that vanish under stress. Vault in app? Great, until app freezes during panic and you can't withdraw. Practical: app balance, sovereign vault. Haver 9. How to smell a rotten bank. Simple checks. Loan-to-deposit ratio. High means bank funds loans with risky short-term funding. Watch out. Rising NPLs, non-performing loans, more bad loans equals stress. Shrinking liquidity cushions, low reserves or short-term funding reliance equals danger. Aggressive growth, high leverage. Fast growth funded by cheap credit often ends badly. Opaque disclosures, complex subsidiaries, hiding risk equals red flag. If you see 2+ of these, tighten exposure. Number 10. What you retail legend should actually do. Exact moves why. 1. Don't keep everything in one bank app. Split across 2 to 3 custodians, especially above deposit insurance limits. 2. Know the deposit insurance limit in your country and keep excess elsewhere. T-bills, short-term funds. 3. Check app custody. Is it pooled, insured? Who is the custodian? If unknown, be wary. 4. Avoid leverage in shaky times. Margin plus bank stress equals instant forced selling. 5. Keep short-duration safe assets, T-bills, ultra-short funds, as emergency cash, not your app's fixed product. 6. If the bank stock tanks or rumors swirl, don't panic sell, but don't be blind either. Evaluate withdrawal ease, insurance, and alternatives. 7. Use limits for trading in illiquid bank stocks. Stop hunting equals avoid getting executed at the worst time. 8. If you run a large amount insured limit, diversify custodians or use treasury instruments. Number 11. Roasts. Because you asked for chaos, Kartikeya Chutia. My money is in one app. It's safe. App freezes. Where is my money? Bro, safety is not pretty UI. Sudhanshu Chutia. Banks love us. They're family. Family doesn't charge you 36% on cards. Wake up. Goldie Buy reads bank balance sheets, quietly moves cash to short-term treasuries, sips chai while others panic. Be Goldie. 12. Quick crisis playbook. When bank stress hits, move non-insured cash to government T-bills or short-term treasuries. Reduce leverage and close margin positions. Use bank-insured withdrawals only if you need immediate liquidity. Otherwise, plan an orderly transfer to safe custodians. If exchanges apps freeze, document everything and follow official instructions, but assume withdrawals will be slow. Number 13. Final mic drop. Tattoo it on your screen. Open quote. Banks turned your trust into leverage and then sold you the bill. If you don't know who actually holds your deposit, you're not a customer. You're part of someone else's balance sheet. Close quote. Want this?